Welcome to VisionQuest Wealth Management Third Quarter Investment Commentary. Throughout the year, we've written things like deja vu all over again or same thing again. And quite frankly, all year long, you could have basically read the same exact commentary from the quarter before, and the message would have been very similar. This quarter, I thought for the first time in my life, I was actually going to get my term paper done early, and I started working around the beginning of September. Steve Peters and I sat down and started to put together what the commentary would look like. And again, it looked much like it was in the past. But this time the title was, Here We Go. Since that commentary that we started to write in the first week of September, things have changed actually pretty dramatically. And we've finally seen this correction that we've been predicting all year. Does that make us geniuses for actually predicting this? No, that's much like the guys on TV. Eventually they're right. The bulls say it's going to go up, it's going to go up, it's going to go up. The bears say it's going to go down, it's going to go down, it's going to go down. Eventually the markets go through these different signals. Now, as we started to do this, we started to get a lot of calls this quarter on many different things. And in my experience, advisors tell me things like, we've trained our clients not to give us calls during these times. Our clients don't panic. So imagine that. They actually attribute panic with a phone call. In our case, we don't see it that way. We thought they were all great questions, and we want to address some of those today, as well as give you some really high level on what happened in the markets. First of all, in the large cap US sector, basically stocks were up about 1%, right? Not too much going on. They still continue to perform okay for the year. And that's where we usually have most of our money actually allocated to. In the small cap sector, those stocks have been down about 6 to 7% this year. And again, that's typically where we have smaller weightings. International stocks, emerging stocks, down 6 and minus 3.5 respectively. Public debt instruments actually were down just a little bit during the quarter. And alternatives, which have really kind of carried the day all year, believe it or not, even when the market was doing well, alternatives had done much better, were actually finally down. That being said, you'll probably hear us talk a little bit about alternatives going forward and maybe adding some to your portfolio as we see more market volatility about to happen. Of course, our private debt instruments performed very well, giving north of 2% for the quarter. So what were some of the big things that happened out there? Well, first and foremost, many of our clients were asking, why now? There's lots of stuff going on in the world, but hasn't affected us up to this point. In fact, as a former military officer, I have a lot of friends still in the military, and they said when Putin was doing his thing in Ukraine, it was actually much worse than what we were reading about over here. I think why now is it's starting to hit close to home. So you have ISIS and Ebola, and those things are having a tremendous effect on what's going on. We're seeing the things with ISIS where they're basically, they're abducting people. They have a real army. There's a real fear in the U.S. And, of course, the Ebola virus. I do want to remind people, though, that the Ebola virus has only killed one person in the U.S. so far. So not to minimize it, but it has struck fear. And when you strike fear in travel, you strike fear in the economy. So remember, the market's kind of a leading indicator and maybe predicting that based on these two fears, travel and movement of the world economy would slow down. The other thing that I hear an awful lot about is China and the yuan, which is actually traded as the renminbi, taking over as the world's reserve currency. There's a couple things to remember here. We've heard this story before. Let me think. 1980s when the Japanese bought Rockefeller Center, most of LA, most of Honolulu. We were being told then that the yen would take over as the reserve currency. However, it never happened. Most people don't realize this, but the euro, the economies that the euro were based on, has been the largest economy in the world for 10 straight years through 2012. Yet we didn't change to that currency either. So keep in mind, China, while they've become a stronger and stronger economy, also trashes human rights on a daily basis, also has been known to manipulate their currency at every turn. There are no debt instruments to invest in China. The reality is, for anybody that wants to know, we could spend a lot more time on the subject, but you have to ask yourself, would the world's developed economies actually trust China to run the world's reserve currency? It's highly doubtful that they would. There's still something to be said for, backed by the full faith and credit of the United States of America, that people around the world take a certain level of comfort in. The last question I've been getting an awful lot is about inflation. And one client asked a great question: are we going to face hyperinflation based on all the Fed's actions over the last few years, the money that was being flowing into the economy? The reality is the money never really got there. In retrospect, we look and say that maybe we should have forced the banks to loan, but they don't loan. For those of you that own a business out there, you know that the banks' loan standards are tougher than ever. They get money for free. They loan it out at an interest rate. They're not taking any risk on it. So that hasn't flowed into the market. The biggest harbinger of real inflation to us, not the normal kind of inflation that we would be prepared for, that kind of black swan inflation, would be the job market. And when people can start going to their bosses again and saying, I'm going to leave this company if I don't get a 10, 15, or 20% raise because of all the job opportunities I have somewhere else. I think that most bosses today, and maybe you are one if you're watching this, would say, I'm really sorry to see you go. You're a really important part of our team here, but I do have these 10 resumes right here of people that want to take your job. That still seems to be the job market. Perfect unemployment, believe it or not, in the U.S. is really about 3% unemployment, and that keeps the markets and inflation and all those things at a certain level of balance. We're still close to 7, and I think most people would say that wages and those kind of pressures haven't really moved dramatically in the last 4 or 5 years. So from a certain level, we're safe there. We never want to minimize anything. We lose sleep when the markets go down and our clients lose money. But we're prepared for it. And we've built your portfolios to withstand any of those issues that you think are coming. However, we'll continue to make adjustments. And we'll continue to make adjustments for those of you that are on track for your goals but maybe losing sleep. So if you're on track and the markets are worrying you, we can make adjustments. If you're on track but you want to try to time the markets and figure out the best time to get in and out, that's something that we won't probably help you with. Nobody's ever been successful at doing it in the past. Finally, for our clients that are nearing retirement age, we are looking very closely at their portfolios, and we will be having conversations with you based on the fact that you're probably on track for your goals already. We can make some pretty good adjustments to combat what may or may not happen to the markets in the future. I hope you attend tomorrow's live question and answer session so that I can answer any questions that you may have in more depth. Thank you.